Happy Wednesday, May 27th. Welcome to another exciting edition of Rate Desk. I'm your host, Michael Thomas, here to talk about multifamily interest rates and other news. Going to the markets today, the S&P 500 is on a 3-day winning streak. Nice to see. We are also seeing that the markets closed at a high for the day, all the major indices. Crude oil futures are down a little bit. They're now in the high $32 barrel range off of 33 from yesterday. And the US 10-year Treasury yield tightened just a little bit by about a basis point from yesterday, trading at 69 basis points or 0.69 today. HUD FHA multifamily rates 223F flat to yesterday, 250. Looking at the 221D4, quoting at 315, 3.15. Going over to the agencies, a little change there. We are seeing some tightening in the Fannie Mae DUS. So tightened about 3 basis points. So we're looking at 317 today on a 10-year fix. That is 3.17. And the Freddie Mac loans are still flat at 320. What I want to talk to you about today. Well, one thing I want to mention first and foremost, I'm looking at a low-income housing tax credit development and doing the permanent takeout with a 223F FHA insured loan. Remember, I just quoted that at 2.50. What does that mean? Well, that means that the loan constant, which HUD calls the sum of rates, which is used to determine the maximum mortgage amount that can support the loan based on the debt service coverage requirement. Okay, different types of affordability have different requirements. If it's 90% or above Section 8, it's a 1.11. If it is another type of affordable, let's say it's a low-income housing tax credit project that doesn't have any rental assistance at all, you're going to be at 1.15. So this low debt constant today, which is in the high 4s, really is yielding a much larger mortgage. Typically in these loans, you see them as debt service constrained. But because rates are so low, I'm seeing a much bigger loan than is even necessary for the takeout. In other words, the loan is oversourced, if you can believe that. So when you're looking at a 223F loan, I recommend doing it early in the process, because guess what? You might not have to get as many grants or different funding sources if you start off with the best loan in the market in terms of loan size for the permanent takeout. Just a note, something that came up today, I wanted to make sure that I shared that with you. One more thought, I wanted to just follow up on this from yesterday's discussion about reopening and amenities. If you're an owner and you've got properties, are you going to do something for your tenants who may have not had access to the common area amenities, the pool, the hot tub, the game room, the computer center, and whatever else you have, dog washing stations, I don't know. Are you going to do anything for them? Are you going to provide them some sort of thank you or some kind of an incentive? It's just a thought as we move forward through these times and things do stabilize and we get back to normal. Boy, it'd be nice to see some type of an acknowledgement or some kind of an incentive provided that really shows that the owners understand that these lack of amenities, while caused by a force majeure, are something economic, right? I mean, we pay for these as tenants in our rent. So, as an owner, are there things that you're thinking about? Anything I think would be good here, right? Anything would be good here. So, I'm going to leave you with that thought today. Appreciate you tuning in for another edition of Rate Desk. I am your host, Michael Thomas, signing off.